Hey, I'm Alex Miles, co-founder of Token Tax, a crypto tax software and accounting startup. Today, we're talking crypto tax basics. We'll answer the following questions. When is crypto taxes income versus capital gains? What are the crypto tax rates? How do you calculate a capital gain or loss? How do crypto accounting methods affect your tax liability? First off, how is crypto taxed in the US? When is it taxed as income and when as capital gains? Earnings are capital gains if they come from appreciation of an asset. In other words, if you purchase an asset, hold it, and then sell it for more than you paid for it, your profit is a capital gain. For example, imagine you buy one BTC for $20,000. You hold it for 18 months and then sell it for $30,000. You have realized $10,000 of capital gains. This is because your balance remained the same, but its value grew. Be aware, you realize a capital gain or loss every time you sell or swap crypto, even if you don't receive fiat currency in return. Common examples of crypto capital gain events include trading or swapping one crypto for another, selling crypto for fiat, using crypto to pay for a good or service. Crypto earnings are taxed as income when additional coins have been deposited into your wallet. For example, if you have additional C tokens deposited into your wallet as lending interest, these are taxed as income. Some common crypto events include lending interest, staking rewards, earning crypto wages, receiving crypto as payment for a good or service. To recap, if your balance of an asset remains the same, but you exchange it for more than you paid for it, you have a capital gain. If your wallet's balance increases because you received additional tokens, you have income. What is the crypto tax rate? Capital gains earnings can be taxed according to two different scales. This is because the IRS wants to encourage traders to make long-term trades, so it taxes them at a lower rate. If you hold an asset for a year or less, you've realized a short-term gain. These are taxed at the rate which your ordinary income is taxed, which generally range from 0 to 37%. Things are different for long-term capital gains. If you hold an asset for more than a year before selling or exchanging it, your profits receive the lower capital gains tax rate, which can be 0, 15%, or 20%, depending on your gross income. For this reason, from a tax perspective, it's often advantageous to prioritize long-term trades. How do you calculate a capital gain or loss? The basic formula for calculating a capital gain or loss is proceeds minus cost basis equals capital gain or loss. In this formula, the term proceeds refers to the total amount you receive in exchange for an asset. Cost basis is an important term in taxation. It refers to the price you paid for an asset plus any sales-related fees, such as Ethereum gas or platform transaction fees. It's important to keep track of these fees because by adding them to your tax basis, you decrease your capital gain or increase your capital loss. This leads to lower taxable income. For example, imagine Jordan paid 3 ETH for an NFT when ETH was valued at $3,000. To make the transaction, he had to pay $200 in gas and platform fees. He later sells the NFT for the equivalent of $10,000. If Jordan didn't include fees in his cost basis, he would have a capital gain of $1,000. However, if he does include them, this gain decreases to $800. Over time, these fees add up, and if added to your cost basis, can have a meaningful impact on your tax totals. If you're using token tax, any ETH gas fees or transaction fees on trades made on supported exchanges will be automatically identified and included in your cost basis. You can also create a running report of the amount you've spent on gas fees over the course of the year. How do crypto accounting methods affect your tax liability? The IRS allows taxpayers to use specific identification accounting to calculate their crypto capital gains and losses. This refers to a method that tracks individual tax lots of the same cryptocurrency separately, so that each lot has a unique cost basis. Doing this gives the taxpayer more control over their capital gains. With specific ID accounting, taxpayers can match up acquisitions and disposals using FIFO, LIFO, or HIFO. FIFO stands for first in, first out, and means that the first tax lots acquired are the first tax lots to be disposed of. LIFO stands for last in, first out, and means the last assets acquired are the first units to be sold. HIFO stands for highest in, first out, and you guessed it, means the highest value assets are the first ones to be disposed of. Because of the volatility of the crypto market, the method you choose can have a big impact on your capital gains totals in a given tax year. Let's explain with an example. Suppose Diana buys 10 LTC when it's trading for $40 for a total of $400. Later, she buys another 10 LTC for $1,500. Even later, she buys another 10 LTC when it is trading for $80 for a total of $800. Finally, she sells 10 LTC for $3,000. With FIFO, Diana would set her cost basis for the sale as $400 because she acquired assets at that price first. With LIFO, she would set her cost basis for the sale as $800 because she acquired assets at that price last. With HIFO, she would set her cost basis for the sale as $1,500 because that was what the highest cost per unit she paid for that asset was. This example lets us see clearly how different specific ID accounting methods can change Diana's capital gains totals. Depending on whether her strategy is to minimize or maximize gains, Diana could select which method she wants to use. Thanks for watching. For more about token tax or to preview how our tax dashboard works, click on the link in the description.